Big risk I'm worried about is jobs. And again, if you don't have a job, you're not consuming. If you're not consuming, earning expectations get hit. About 3 weeks ago, I was speaking to a group of U.S. corporate CFOs, Chatham House, so no names, no companies, but big companies everyone on this podcast knows. And I asked them at the beginning of the evening, I said, raise your hand if you're planning to increase headcount next year. 0 hands went up. I said, okay, how about keeping it steady? Maybe like 3 hands. 30 hands for job cuts next year. The bias is more job cuts are coming. So then we got into, well, what's driving that? The economy is slowing, but it's not bad. And it's AI. So all these companies are getting pressured by their CEOs, their boards, their shareholders to be using more AI. Using more AI is a cost. You have to buy subscriptions, you have to implement, you have to train your staff, you have to, monitor cybersecurity, et cetera. And they're also being told, cool, get AI, but don't increase your budget. So you got to find offsets, and the offsets are personnel.
Welcome to the Risk Reversal Podcast. I am Dan Nathan. That's Guy Adami. Hi, Guy.
Hello, Dan.
You're all knotted up. And, the folks, I guess you're big fans. They're Fast Money fans. If we make it to January, it'll be how many years they've suffered?
19 years.
Not
hard
suffered.
to believe.
Enjoyed
hard
you.
To believe.
But Guy is always knotted up. We have a very special guest. We both met her on the sets of Fast Money. This goes back at least 10 years ago. This is Rebecca Patterson. She is the senior fellow at the Council on Foreign Relations and former chief investment strategist at Bridgewater Associates. Rebecca, welcome back to the podcast.
It's so good to see you guys.
So, Guy, this is a really funny story because Guy often will say, you know what I was doing this morning about 8:32 or so? You were listening to a giant of financial media on the radio. His name is Tom Keene. I've never met Tom Keene. I'm not talking about his stature. He's a big man, isn't he?
Yes.
So this was a month ago, almost to the date. We were recording this Thursday afternoon, September 4th. Tomorrow morning, you will already be listening to this. You will know about the all-important August jobs report. But I was listening for your commentary. This was the July all-important job report. And it's funny. You were breaking it down real time. You were excellent as always. But, Tom asked her, are you going to be out at Jackson Hole at the big Fed confab there in a couple weeks? And you said, no, unfortunately, I have to drop my daughter off at college. And this is where things got really funny. And he said, do you have to do that whole thing where you dress up their dorm and this and that or whatever? And Rebecca says, matter of fact, she says, no, she's a big girl. I just drop her with her bags and then I leave, which I thought was so, it's kind of Guy Adami-ish too. Is that how it went?
Yeah, largely. She's a minimalist.
Patterson, for sure.
And I am not the mom who, no judgment. If someone wants to decorate their kid's dorm and they can afford it, makes them happy, good for them.
It's funny.
It's not me.
We had a double drop off the same weekend and I was just preparing it. It just was going to be horrible. And my kids are also big kids. Like we didn't have to do a whole heck of a lot. Guy, you had a year where you had a triple drop off at the same school. How about that?
Yeah, we had a couple of years in a row of the triple drop off. But listen, you raise your kids to be independent, to be able to do those things. And, thankfully, they were all able to do their own thing. So it made what could have been a very trying experience, somewhat actually enjoyable.
Exactly. Yeah, no, I love it. We drop off, we do a grocery shop, we go out for a nice dinner, have a well-deserved cocktail, and then I go home.
But so you are, your daughter is, without doxing you, is at your alma mater. Is that correct or no?
Yes, one of them.
That's very cool. And
Yes.
Guy's children were at his alma mater, which is kind of cool. My children are at my wife's alma mater.
That's
so,
nice.
Yeah, pretty good, right?
It is nice.
So we've had a lot of fun with all that. All right, guys, should we just get into it? Because by the time folks, like I said, are listening to this, things might get a little funky in the markets, not just the stock market, but obviously maybe the bond market too.
Yeah, I think we should. And, I think the last time Rebecca was with us was August 2nd, and the market's basically been on autopilot. And I think if you listen to Fast Money, watch Fast Money, listen, you know that I've been generally very cautious, and it's not right to be cautious because we're here at an S&P basically at all-time highs. So let's just start from there, Rebecca, because this market is seemingly impervious to just about everything thrown at it, be it in the geopolitical side, be it on the fundamental side, technical side, valuate, you name it. The market's gotten it thrown at it, and it's just continued to stare down the barrel and say, you know what, we're going higher.
Yeah, no, I agree. I mean, I look back at what I've been saying this year, and in hindsight, I've been too cautious. I mean, I have kept exposure in tech despite the crowding, the valuations, et cetera, because I do believe that these companies have insane free cash flow and they're going to keep investing in their own innovation. I want to play that story. But I've been barbelling that with things like staples and utilities because I am looking at the uncertainty with policy, the cooling labor market, et cetera, and it's made me nervous. So this is what I needed to do. And then, with bonds, amazing how stable they've been with unprecedented questions around the central bank's independence. I've been barbelling, if you will, my diversified part of my portfolio with gold, and I've had that on for 2 years now. That one's worked out pretty nicely, I have to say.
So when you think about some of the sectors that you have been exposed on, you
Right.
just mentioned that there's some that you've been, underweight and, obviously looking back, you wish you weren't, but there was an opportunity to kind of get back in the markets. Guy and I were definitely not in the camp of pressing the lows. I don't think either one of us thought we were going to be sniffing 6,000 in the S&P 500 anytime soon. We obviously got briefly above 6,400. What were some of the sectors that worked for you in that sort of downward volatility, and have they continued to work as we march back towards all-time highs?
Yeah, I mean, I think that where I've wanted to lean to complement the tech, right? And it is looking at other structural themes. I think global defense is a structural theme that I've continued to like. That's done fairly well. And then with utilities, I'm leaning on that because it's historically been a good performer in down markets, which we haven't had yet, but I'm still convinced is coming, maybe next year. And we can talk about why I think that. But then the utilities, again, it's part of the AI structural trade as well. It's part of building the data centers, getting the electricity supply to meet the demand that's growing by leaps and bounds. So it's all tied together, but I have been avoiding the financials. I know you all talk about that all the time, and they've done great. We've had IPOs and M&A coming back a little bit. We've had consumer spending. We've had a ton of volatility in markets, helping with the trading floor revenues. And that's one I've been a little more nervous about. And, in hindsight, that was a miss for me. I think the one other area that has worked would be the dollar. So I've been bearish on the dollar this year. Even though the dollar stabilized recently, I still think the medium longer term trend ahead of us is lower. And so that tells me to make sure I'm also diversifying, not just within sectors in the US, but also globally. It's harder right now. If you're thinking about where do I go for safety but stay in the equity market, normally if you want safety in the equity market, you go to the UK, you go to Switzerland. And Switzerland's gotten hit over the head with tariffs. Their currency is incredibly strong, so you make money on the currency if you don't hedge, but they're getting hit. And the UK has the same fiscal sustainability issues that the US does, but because their markets are smaller, you're seeing the contagion from their bond market starting to leak into their equity market. So some of the safe global diversification trades from the last 20 years are not working this time around for good reason. But it's an interesting situation we're in. And I think I'm sharing this just because your listeners, your viewers, don't rely on the last 20 years as your playbook. We're in a different regime. That playbook is not going to help you right now.
All right, so let's play it out because you mentioned Switzerland. I think their debt to GDP is about 30% as opposed to the United States, which is probably approaching 122, 123% debt to GDP. But the global European bond markets are seemingly breaking down. If you go across Europe, Spain, Italy, Portugal, Germany, the UK, all their yields have been moving higher in a pretty significant way, despite the fact that some of these countries have been cutting rates. Then you go over to Japan and you see the same thing happening. You said it earlier that you were surprised at how tame our bond market is, despite all the things we're talking about just in the rhetoric. And then you throw on top of that what's going on across the world. How long can that last is my question to you.
So I think there's a couple reasons the U.S. bond market is staying calm despite some of the headlines that we're all talking about every day. I think one is that the supply that's going to be needed to fund the U.S. deficits as they keep getting bigger hasn't come through yet. The Treasury is front-loading new issuance at the front end of the yield curve, and they can play that game for a while longer, but ultimately, just to keep liquidity across the different tenors of bonds, they're going to have to issue more longer duration, so 10 years, 30 years, et cetera. And I think we're probably going to see that come sometime next spring. So it's not tomorrow, but it's going to come, and that'll be an important moment. But that's part of it. We aren't seeing the supply-demand mismatch yet. I think there's also been some reassurance because the tariff revenue has been so big that it's another way to finance, basically, the deficits. Now, That's a fun one, because if the reciprocal tariffs, the ones that were passed under these emergency economic powers, if they're ruled illegal, and it's probably going to go all the way to the Supreme Court, probably pretty quickly, if they're ruled illegal, we give the tariffs back. You could argue that's good for the consumer, so that's good for earnings, but it's really bad for funding deficits, so it's not necessarily good for bonds. So that's going to be an interesting one when we get that decision from the Supreme Court, how that plays through into markets. But I think the tariff revenue right now is helping. And then lastly, there's this hope that we won't see the Fed politicized. And just like Brexit in 2016, we knew that vote was coming. We knew what the polls were telling us, but you didn't see a market reaction until the event actually occurred. And I think we're in a similar place today with the Fed, that the market is watching Stephen Myron testifying in Congress. They're seeing the pressure on Lisa Cook, the governor, over mortgages. But until we actually see the politicization happen, I don't think you get much market reaction. It's just a possibility. It's not a certainty at this point, but it could be a Brexit moment for us. So I wouldn't be just saying, oh, it's all fine, it's going to stay fine.
And we remember what happened there. So you mentioned the weaker dollar, and you think it's going to continue to weaken, as do I, by the way. But Treasury's playing a pretty dangerous game here. And I think whether they acknowledge it or not, and they sort of have around the edges, there's a policy for a weaker dollar, because when you have a $37 trillion debt, despite the fact that a lot of people think you can grow your way out, it's not going to happen. They're going to have to basically devalue the currency their way out. And I think that is the platform they're going down. And, listen, right now, seemingly maybe it's working, but at a certain point, it doesn't work. And I think that's what we're up against now. This weakening dollar, which people think is bullish for equities, at some point that flips. When do you think that is?
Well, it depends what causes the dollar to weaken. If the dollar's weakening because the Fed is easing and it's supporting growth expectations, and so equity expectations also hold up, you could have a benign weaker dollar. And that's what we lived through in 2002 to 2008. That was a period where the dollar had sustained weakness. Stock markets went up. That was the period of BRICS. And so a globally diversified equity portfolio did really, really well in that period, especially emerging markets, which are also benefiting from this weaker dollar. And we can get back to that. The risk, though, is the dollar doesn't have a benign weakening, right? If the Fed does move down this politicized road against a backdrop where inflation is not 1 or 2%, but 3% and possibly climbing, against a backdrop where the debt to GDP is now in triple digits, there's a much higher probability versus the last couple of decades that we could have a more malignant, weaker dollar that is not great for stock markets. I agree with you.
Now, you also mentioned gold, and against that backdrop, gold has obviously done well. Gold's working historically when things that shouldn't be tailwinds for gold is seemingly providing one now. And I recently read that central banks now own more gold than they do treasuries, which I think is sort of interesting. And it's clear to me that this appetite from central banks is not waning at all. So gold, to me, is telling a story that the equity market is choosing not to listen to. But specifically, continued thoughts about gold here, which has been unbelievable.
Yeah, so I started getting bullish on gold initially after Russia invaded Ukraine. And we saw what happened to Russia with the U.S. freezing reserves. And I thought, okay, China is watching this. If I'm China and I own trillions of dollars of U.S. treasuries, I want to be diversifying out of that sooner rather than later. And that's exactly what we've seen, is China has been steadily buying gold to diversify its reserves. At the same time, we also saw Chinese households who are really struggling, right? Confidence is low. The job market, especially if you're young, is not great. They're not spending. But then where do you put your money? Certainly not in housing anymore. The stock market recently they've come back to, but gold has been another place they're going just for safety. And so there's been a household demand there as well. The more recent trade on gold, the central banks are continuing to diversify, but now I think we're seeing more developed market retail interest and institutional interest because of this developed market debt sustainability issue that I think could get legs, as well as just the fact that we have the potential for inflation expectations to rise maybe in an unanchored way. I hope it doesn't happen, but it absolutely could. You want to hedge. That's a great hedge for that.
All right, we got to go back to something you just said about the tariff revenue.
Yeah.
Okay, this is something that you wouldn't expect
Also called a tax.
Yes, correct. But it's what you just said is if we have this deficit, right? If you think about this tax bill, it's meant to add like $4 trillion onto that, right? And, you know, the CBO, which is nonpartisan, has actually come out and said that that tariff revenue could be close to $4 trillion over the next 10 years. So they're kind of matching up a little bit. And your point is that if those, you know, reciprocal tariffs and the fentanyl tariffs, you know, if they go away,
right.
Yeah, we still have tariffs on some really important industries, you know, copper, steel, autos, and there's some others here. But would that cause a bout of volatility if we had to pay back those hundreds of billions of dollars that have already collected? Because think about April. We sold off the stock market. We saw treasuries sold off because of them going on the tariffs. And now the other way. Like, help us explain that a little bit. Like,
so in April, when we had the sell everything trade after Liberation Day, I think that was largely a concern or a perception that the last 80 years, institutional relationships had been broken, right? Bretton Woods, post-Bretton Woods world was gone. In other words, if you're an ally or not, we don't care. We want you to pay. NATO agreements, you know, Canada should be a state. We want Greenland. I mean, there were a lot of things. It wasn't just tariffs. So to me, the fact that a lot of foreign investors sold everything for the month of April, and it has stabilized and even come back a little bit since. But in April, there was kind of a holy moly reaction. So that explained that. But since that, we had the big, beautiful bill. So the April reaction, we didn't have the big, beautiful bill yet. So that wasn't priced in. So today, with that in the rear view mirror, we're like, okay, we're going to have this debt supply coming. The debt GDP is going up further. How do we pay for all this? So now the tariffs they're good and bad. Mm-hmm. Before they were bad. It was a tax on the U.S. consumer. It's going to weigh on consumption. That's over 2/3 of the economy. Now, yes, that's still true. And if we lift them, that's good for the consumer. But if we lose the tariff revenue, how are we funding all this stuff that Congress just passed? So the world's changed from the April reaction to what reaction we could have now because of the fiscal bill that passed. That's what changed the equation and the possible reaction ahead.
All right, so as we said, by the time you're listening to this, we already know the August jobs report. And listen, this has been like a mess, right? As long as I've been in the business for 27 years, I've never seen a piece of data that is going to be so closely examined because the revisions that we had, the July number really disappointing, the firing of the BLS commissioner, that sort of thing. We have an interim commissioner. I guess by all accounts, this person is totally neutral, like, right? Do you expect, you know, listen, if I can't imagine there's going to be a hugely negative print given what's going around, but if there was some sort of indication that the numbers were re-rigged, you know, Trump was calling them rigged, what do you think that would mean for confidence in the markets? Obviously, you'd see the stock market knee-jerk would be lower. You'd probably see a knee-jerk. Wouldn't you see yields go higher in some way, shape, or form?
I would expect a curve steepener,
yeah, okay.
Right? But so yes, longer-term yields higher. I say that though, and it hasn't happened that much so far. I mean, we've seen a number of important steps taken to potentially politicize data, to get rid of data advisors, and now this attack on Governor Lisa Cook at the Federal Reserve Board. And the market reactions, again, have been pretty calm. So I wonder, you know, we'll see what happens with the data when people are listening to this. If there was any perception that it was rigged or manipulated, is that the red line to cross? Yeah. Well, we're going to find out. But I can't imagine there would be. There is an army of really talented, dedicated civil servants who put these data releases together. They're not perfect. Of course, they get revised because it's hard. It's the entire freaking economy. But I would be shocked. If new person comes in and immediately there was something funny going on.
You know, it's funny. You say these dedicated federal workers. Well, look what just happened at the CDC, right? And you can make the argument on many levels. The CDC for our country is maybe not as important as, you know, like the BLS and the Fed. But for all intents and purposes, like when you're thinking about like the safety of our country. We just had this incident, globally.
Yeah.
I could see if you have unprecedented attacks on this sort of thing, like a lot of these folks walking out. I mean, what would you do, right? Remember the Committee to Save America? Well, they didn't last too long in the first administration. So again, let's talk about like what you said, the curve steepener. If we saw the 30-year yield here in the U.S. get above 5%, are there kind of alarm bells going off at that point? We almost got there the other day.
Yeah. If we see the 10-year continuing to inch up towards 5 and the 30-year well over 5, I have to believe that you're going to see some negative reaction in equity markets from that. And again, that steepness, I think, is going to be a sell dollar, buy gold. What's going to be interesting too, without going too far down the crypto path, is people talk about crypto as digital gold or a dollar hedge, but if the stocks are selling off because bond yields pop higher, I would bet money that crypto goes down, not up. And I think it's important because we get people who are selling crypto saying it's digital gold, it's a dollar hedge. But to date, maybe it'll change going forward, it really is more of a fintech equity. When tech stocks do well, when there's liquidity in the system, crypto does well. Now, it has underlying support from the government because they're obviously supporting the development of this space. But I still think if you're thinking this could happen, right, that we have politicization of agencies and the Fed, and we have higher yields, crypto isn't the place I want to hide in that one.
Yeah, there's something that's gone on over the last few months since Ethereum made this big move, and you have all these treasury strategies, and it just seems like people are really focused on Ethereum, and then they're going to make the argument that this is actually a platform that can be built on, where Bitcoin is not that. If you think of all of, and you just said it, I mean, all of the pillars of the bull case going back, at least as long as I've been tracking it, going back to 2017, they're all gone. It really is just a store of value. It's a supply demand sort of thing. The more treasury activity that you see, and Michael Saylor has been articulating this to anybody who will listen, and for now he's been right, but it just seems like a disaster waiting to happen. And I just think the narrative around Ethereum, that's dangerous too, because Tom Lee from Fundstrat, who obviously has been all over this story for a long time, I mean, he's actually speaking. He was on Wilfred Frost's podcast, The Master Investor, last week, and he thinks there's going to be that flippening again. I haven't heard that term. Then what does that mean? That means the market cap of the Ethereum, I guess you call it ecosystem, goes over that of Bitcoin. And Tom remains very bullish on Bitcoin. He still has a $1 million price target. You know what I mean? So again, that just seems a bit frothy to me, a little bit. But let's talk. So you're suggesting that Bitcoin is basically like a correlated NASDAQ long duration sort of
small cap fintech.
Yeah,
that's how I would characterize Bitcoin. Now, I agree. Ethereum is different. It's different what it can do, but Bitcoin is a speculative asset.
Yeah. And so when you think about just the price action, let's call it, in Microsoft, let's call it, in Palantir, I mean, there's been a handful of other like mega cap tech stocks that have not made any progress since their Q2 earnings that reported, let's just say, in the last month or so. And a lot of it is like, maybe people are full up. Maybe people are starting to think about those 30-year getting above 5% and kind of what that means for valuations. Help us explain that. We've been talking a lot about that over the last week and a half or so, as we've seen a lot of these names stall out. Google was a unique situation. We're going to talk about, obviously, generative AI, but help us think about like long duration assets and how we should really view them from a valuation standpoint, which is getting sort of excessive.
Yeah. And I think when you have the so one thing that's been really striking to me is that even with the labor market cooling, stocks and all the geopolitical and policy stuff, stocks march higher. And part of that is the retail investors back. And part of what's allowing the retail investor to be back and keep buying is that they have jobs. At the end of the day, people consume, people have confidence to invest if they have a job and income. And the unemployment rate is still in the low 4s, unless it changes sharply tomorrow when this comes out. So as long as people have jobs and people are consuming, the stock market holds up. They don't necessarily want to get out of the highly valued tech companies, even if there's some signs that it's full up, that it's highly valued, et cetera. What I worry about is the switch. And when I say the switch, I mean enough signs that the labor market is cooling, an acceleration of the labor market cooling, that it starts to weigh on consumption. And that consumption weight starts to hit this retail investor community. And you start people not wanting to pull back, but having to pull back. We haven't seen it yet. But I think it's coming. And to me, it's a matter of, is it this fall or is it early next year? And I think it's going to depend on the speed of job losses. And that gets us back to the labor market.
Yeah. And on the retail front, we've seen some data about margin, right? And I mean, it's getting fairly excessive. We've seen a lot of, again, I just mentioned valuations, but going back to, past, the highs in right before the financial crisis, you can go back to 99, 2000, and retail doesn't seem to be too bothered. And part of it is that maybe a lot of retail, they weren't around. They
exactly.
don't, you know what I mean? And
100%.
And so you and I are
We've
probably
seen this
scarred.
Yeah.
Well, we've mentioned this on the podcast like 1,000 times, probably not recently, but that 2000 high and the 2001 and the 2002, and we didn't bottom until early 2003. That was excruciating. The idea of like a protracted bear market is not something that anybody has like in their purview. And listen, the Fed has done a good job. Like if you think about it, between monetary and then fiscal during COVID, and then what we had, in 2022, that was very orderly, right? It was taking a lot of froth out. 2021 was insane, right? If you think about it. And then what we just had in April, V reversals. That's the game right now.
So let's go back to your prolonged bear market or prolonged U-shaped recovery for the equity market. When I'm not forecasting this, but I think about, could we see that again? What are the conditions that could make that happen? A couple of the conditions would be that the government either doesn't have the political will or doesn't have the financial means to come to the rescue. So we don't see another huge fiscal bailout. And it gets harder to do those big bailouts the higher and higher our debt to GDP goes. So that to me is a concern. I think a second concern is that companies are just reluctant to hire, even if the Fed is cutting rates to try to stimulate the economy. Lower rates make you want to borrow and invest, but it doesn't mean you have to. And we've seen that in Europe. The ECB, the European Central Bank, cut interest rates to zero. They were offering all these cheap loans after the European financial crisis. So they made the conditions attractive, but no one wanted to take them up on it. And it took them a while to recover. I think there is a growing possibility we could live through one of those things here in the US. Again, partly because of the fiscal situation, the government, they may still come to the rescue and just ignore what the deficit and debts are again. But at some point, that is going to be a constraint. And then can the Fed come to the rescue? Well, right now they can. Rates are relatively high. They have room to cut. But what if inflation is still at 3% or 3.5% or 4%? How much are they going to cut in that situation, worrying about inflation expectations? So we could be in a bit of a trap, right? Whereas if the job market slows, equities come down, that normal V shape happens because you get a government / and or Fed reaction function. There are reasons the reaction function might not be as effective or as quick this time around. So it's just something to think about. What's different today from the last couple of decades?
All right. So the playbook, it was that way in the early 2000s. It was that in the financial crisis. It was that way during COVID, is you just go to zero, right? Fed funds goes to zero. And it seems like we will not need a crisis to see Fed funds rate down, down to 2% or something like that if we have a Fed chair in next year. So just give us a sense if like the independence of that institution is severely, severely compromised. And you have, listen, they're interviewing folks right now, for this job. We might have a shadow Fed. Treasury Secretary Bessent, you might know him. You don't have to opine on him. The intellectual dishonesty that has gone on in this administration for anyone who's meant to advise on, economic policy is absolutely amazing to me. Before we even saw this massive attack on the Fed, that should have been like warning bells screaming in silence, okay? But it wasn't. So if we do have a Fed chair that's going to be nominated, I don't know when would the nomination happen?
It could happen tomorrow. I mean, there's no specific date. It has to happen.
And when would the hearings be?
Well, Powell's his term ends in May. They want to have it done well ahead of that so there can be a smooth transition. So normally you would expect the nominations to happen towards the end of this year, early next year. Nominations Q1, and then by well before May we'd have the name and it would all be done and dusted.
So won't the market market start anticipating what this new Fed chair and
absolutely.
remade governors, which might also come after the presidents, if this is just an arm, a political arm of the White House, what do you think markets do? I mean, forget the equity market. What do you think bond market?
Well, we have examples. That's the good news. I mean, we can look at the U.S. with Arthur Burns, but we can also look at other countries that have gone through this. I wrote a piece for the New York Times a few months ago where I looked at Turkey and Hungary that had politicized their central banks. The governments had pushed them to enact policies to cut rates to support growth regardless of inflation. We've also seen this movie in Argentina. We've seen it to a degree in Venezuela. So yes, these are all emerging markets, but this is what we're talking about in every case. And America is not that, right? Our bond market is the world's dominant bond market. Our dollar is the world reserve currency. So I'm not saying we're Hungary or Argentina, but directionally, I think the same reaction function happens, which is if you have a politicized central bank, you are going to see inflation expectations unanchor. So inflation expectations go up, they'll drag actual inflation up. So you have higher inflation. Now, in those countries, equities did okay for a while, which is super interesting to me. The currencies devalued. People in those countries had to choose, do I want to put my money in a bond or a stock? And bond markets were selling off, yields were rising, especially at the long end. So those were losing money. So you lost money on your currency or bond. So they didn't know where else to go. They went to equities, especially equities that would benefit from being more competitive, right? So export stocks. And so the equity market held up relatively well despite this. Now, I don't think the US necessarily is the same way. If our exports are more competitive overseas, okay, that will help. But we have to make sure there's overseas growth and demand for our stuff. And if the rest of the world is slowing, that might not be the case. And Americans have a lot of choices where they can put their money. So they could go overseas, they could do a lot of other different things. So it's not clear to me if we will get the same positive stock reaction we got in those other countries, but I definitely think we get a weaker currency, we get faster inflation, which is going to hurt consumers and ultimately weigh on stocks. And we're going to see a lot higher borrowing costs, which is going to create this negative flywheel on the debt sustainability. And then suddenly we look like Liz Truss.
Yeah. Well,
Truss, excuse me.
Not for that long either.
Right.
Actually, she was on Wilfred again. I'm just going to keep pimping out his podcast.
We like him.
Yeah,
I
love
him.
Wilf. And he had Liz Truss on this
That's
week.
awesome.
So it's in your favorite podcast store. I haven't listened to it yet. I will. I'm on a long flight tomorrow. Good stuff. We'll put that in the show notes. All right. We're also going to put this in the show notes. This is the piece that you wrote for CFR here. Will artificial intelligence do more harm than good for U.S. growth? Now, let's just kind of set this up for a second. If you think about the CapEx, and I know you hit this in your piece, that we've seen over the last now 2.5 years or so, it's driven a lot of activity throughout our entire, economy. We've also seen from the stock market standpoint that the stocks that have, basically been the early winners, whether hyperscalers, NVIDIA, and the like, and they're not too many more. But they've accrued trillions of dollars in market cap. Last year, NVIDIA alone was 25% of the S&P 500's 25% gains. Now, it doesn't look like we're going to have that sort of activity right now. We're in the back half of the year, that sort of thing. But what is your thought process here, and what do you think the ramifications are for our economy, but also the stock market?
Right. So that was a great summary. The CapEx from these AI-related companies has been incredible. From the end of last year to the middle of this year, it was actually a bigger contribution to GDP than the consumer, which is unbelievably unusual. Now, I think going forward, there's no reason to expect CapEx to suddenly stop. It'll probably continue to be strong and a big support. Fine. But there's two other things to think about. One, you mentioned the stocks going up. So the stocks going up creates household wealth. Household wealth supports consumption, which supports earnings and the economy. Are those stocks going to keep going up? If the Fed gets politicized, if the Fed doesn't cut as much as expected, two sides of the same coin, but different problems. If there's just a policy decision that makes people want to get out of stocks to a degree, anything, given how overowned they are and the valuations. So you could see the wealth creation doesn't continue to the same degree. So that's one risk. But the big risk I'm worried about is jobs. And again, if you don't have a job, you're not consuming. If you're not consuming, earning expectations get hit. And what triggered this idea for me, about 3 weeks ago, I was speaking to a group of U.S. corporate CFOs, Chatham House, so no names, no companies, but big companies everyone on this podcast knows. And I asked them at the beginning of the evening, I said, raise your hand if you're planning to increase headcount next year. 0 hands went up. I said, oh, okay, how about keeping it steady? Maybe like 3 hands. 30 hands for job cuts next year. Now, I didn't get into the weeds with them on how many job cuts. It might be very minimal, but the bias is more job cuts are coming. So then we got into, well, what's driving that? The economy's slowing, but it's not bad. And it's AI. So all these companies are getting pressured by their CEOs, their boards, their shareholders to be using more AI. Using more AI is a cost. You have to buy subscriptions, you have to implement, you have to train your staff, you have to, monitor cybersecurity, et cetera. And they're also being told, cool, get AI, but don't increase your budget. So you got to find offsets, and the offsets are personnel. Some of the personnel cuts are AI replacements, right? If I have 10 investor relations people, maybe now I need 2. But some of it is just, I need to find offsets to the cost, and personnel is the biggest cost for most companies. And so you're going to see, I think, more layoffs as the pressure on CFOs and organizations to keep budgets flat or even get them a little tighter continues. And we're seeing that already in things like Challenger and Gray, the layoff announcement surveys. There was a great survey in August of CEOs asking them, how many of you are planning to hire or cut heads next year? 34% cutting. That was more than the percent planning to increase heads for the first time since 2020.
Yeah.
So it tells me it's coming. It's a matter of degree. But if the job cuts come, AI is not directly responsible for all of it, but it's a heavy influence on all of it. So that was my point of the piece.
Well, you can also probably bolt this on, and maybe my friend was at the same event that you were, a couple of CEOs and CFOs at a Chatham House sort of situation here, basically said that, we learned a lot with work from home during COVID.
Yeah.
We had these VPNs, we saw what our people were doing, and 80% of them were doing nothing 80% of the time, which is pretty fascinating when you think about, right? And if you think about AI and some of these businesses, it's going to be intelligent assistance for existing employees, but other, remedial sort of tasks and stuff like that are obviously going to go away. And so I just wonder if that's the next leg of this trade. If you see the hyperscalers, if you see all these companies that have benefited and really accrued all of the market cap for, for the most part, if that trade chills out, and I don't mean that's great for the indices, you know what I mean? Because just think of the weight of them.
Yeah.
You're not going to see the insurance industry. You're not going to see, you look at Salesforce. Look what they had to say. They're not even seeing uptake by, they have thousands of customers. They are using their agent force internally, and they're getting some productivity gains, maybe, but they're not seeing a big uptake from it. Right. So that will be something that'll probably be a back half 2026 thing where people are going to start putting their finger on some industries that are actually really starting to see the ROI.
Right. We're all waiting for this productivity boom, and the White House certainly is counting on it. When they say we're going to have GDP growth during Trump's term of 5%, God bless. I'd love that. We'd all love that. How are you getting 5%? The tariffs basically offset the fiscal stimulus of the big, beautiful bill. So there's no net support coming from that when you put those two things together. The Fed cutting rates, if it does, could be supportive, but it depends if it's a politicized Fed cutting rates or not. And it depends what inflation's doing. So you need AI to create this productivity boom. And I don't think any of us have a clue how big it's going to be or when exactly we're going to see it. So honestly, it's a guess. So I think you're right, though. People are going to want to see that ROI. They're going to look for the productivity, if not a boom, at least signs that there's something happening.
Well, you remember that old saying about Intel, they like to spend their way out of a recession, right? And so we might see that. It might take a downturn. It might take pricing pressure on, compute in general, right? And who knows? That might be the thing that causes a V reversal in the next downturn in the equity market. But the other thing that kind of struck me earlier in the week, we saw ConocoPhillips. They're cutting 25% of their workforce, 3,300 workers, because of not because of AI, you know what I mean? Because of weak demand, like that sort of thing. So talk about that, because when you saw these hands going up, some of the CEOs and CFOs were probably giddy about it when they were raising their hands. Others for different reasons, because they know they're not going to get the benefits of this sort of stuff for at least a couple of years. And maybe, they're starting to anticipate a weaker global economy.
Right. So again, some of the job cuts are because of AI. Some are just because it's an uncertain economic climate and they're getting pressured to keep budgets under tight or reduce spending, as I think was happening with ConocoPhillips. One thing on the labor market that's important for this conversation we're having right now is that we're going to have the October labor market report, so a little ways off. That's going to include all of the federal job cuts where people had taken deferred retirement. So all of those people leaving the labor force, that's going to hit in that report, which will come out at the beginning of November. So that's going to be an ugly labor market report. Now, the market will expect it. It's not a surprise, but it's still going to be ugly. And what we know from history is if we already have uncertainty, we have some layoffs coming, the unemployment rate is starting to tick higher. It doesn't take much to get a bit of a hockey stick movement where we go kind of drip, drip, drip with job cuts to suddenly, okay, cut 10%, everybody. Or 15 or 20. Again, I hope that doesn't happen next year, but we're seeing, again, you and I have been doing this long enough, for better or worse. We've seen this before. I don't see what's going to magically come in the next 6 months that is going to be a new source of growth that stops the trend we're seeing in the labor market. I don't see it. I'm looking for it. I haven't found it yet.
It just seems like, in past environments like this, where there's so much economic uncertainty, where there's so much sort of policy that's being pushed through, whether it was a nonpartisan tax bill to the size at which it was, to these tariffs that are unprecedented, right? It doesn't feel like we have the sort of steady hands that we have in crises past. And I don't mean to just call this flat out a crisis, but there is a crisis of confidence in institutions right now. And I think there's going to be a crisis in confidence in our country, who have led in this kind of liberal democratic world order that we helped create over the last 80 years or so. And I think that we're kind of in many ways, and I know that you've written some amazing pieces in the New York Times, opinion pieces over the last year and a half. And I think you've been a great voice in a nonpartisan way. I can do the other way. You know what I mean? Like I really feel like we're whistling past the graveyard. I think we're going to have federalized troops in New York City. I feel like we're going to have people like Jamie Dimon who are not willing to speak up. And these are people that have really benefited from this being the country that we are, the democracy, the capitalistic society that we are. And they've relied on foreign investment and foreign, all that sort of stuff. And I could see that going away really quickly. And I know I don't mean to sound alarmist, but this is the way in which it's going. So I don't know. Help me as we get out of here. Help me be a little bit more optimistic about this.
Let's think about, I share all of your concerns. I absolutely share your concerns. And it's part of the reason I have been writing so much, because even if I don't change someone's mind, I want to get facts out there and just say it not in a political way, in a balanced, fact-based way. Here's what's happening. Here's what it means for you. And just make sure people are educated so they can see what's happening and how it could affect their lives. But look, we are near all-time highs for the stock market, despite all this stuff that we just talked about. And the consumer is still spending. Not everybody to the same degree, right? It's mainly the wealthy, but they're still spending and they're keeping things going. So what could go right? The Fed is not politicized. We see Lisa Cook get to stay in her job. The governors don't have a majority that allows them to fire presidents next year. So that would be a relief. And I think that's a very possible outcome. We could see the job cuts that I've been describing prove to be incremental and not large, in which case we can have slower growth, but the equity market can do fine with slower growth, right? We continue to see progress on AI, and maybe one of these wonderful companies actually announces AGI, super intelligence, woohoo, in the next year. And I think you'd get a hockey stick moment on that, just like we did with ChatGPT in November 2022.
Or maybe that's the sell the news sort of situation, because I remember...
Well, you asked me what could go right, and let's be happy.
What's funny, so this is, to be honest with you, what I just said, my little soliloquy there, has very little to do about how I feel about the stock market. So just to be clear on that. And I love the way in which we just close this out with you giving us this choose your own adventure, you know what I mean, on the way out.
Well, I'm just trying to think, we're in a world today with bigger than normal tail risks on both sides. And I think for any good investor, you're developing your base case, how you see the world, but then you're also thinking, what could make me wrong? And if I'm wrong, what do I need to do about it in my portfolio? And so We spent a good chunk of this time talking about some of the negative risks with the labor market, et cetera. There are some positive risks that could happen. And so I wanted to at least spend a second touching on those. But the main thing is despite low vol in the VIX and MOVE index, et cetera, this is a high tail risk world. And so everyone should be thinking about what could happen that's reasonable. Like, we're not going to predict any unknown. What could happen? And if it does, what would I want to do with my portfolio, and get that plan in advance? Yeah. I spoke with a couple hundred public pension plans in Utah earlier this week. And that was a big part of the conversation. And a lot of these plans have crisis committees now. So they get together regularly and try to say, how do we protect our members, the retired fire people, the retired police officers, et cetera, if something goes pear-shaped? I feel like all of us should be doing that exercise.
All right. Well, I hope we have those positive outcomes in spite of some of the other negative tail risks that are going on away from markets and the like. So, Rebecca Patterson, it's always a pleasure. I'm sure I'll see you on CNBC on the desk at Fast Money really soon.
Yep.
We will put your report on the CFR. It was great. So we'll put that in the show notes. We really appreciate it.
Thank you. No, thanks for having me. It's always fun talking with you and Guy.